All right. Good late Monday evening, early Tuesday morning, depends on where you are. All right. I could have labeled this everything you need to know about margin, but we're afraid to ask. But I think more simply, I wanted to delineate it as everything you need to know about margin to survive. Okay. Margin can be very dangerous. And it can be very beneficial in the right circumstances with the right skills and knowledge. So I'll probably do another one that says everything you need to know about margin to thrive. Okay. So this one's going to lean on the conservative side, explain the basics to you. Um, and also, I've seen some content out there, but most of it's old and it doesn't really take into account um, the high yield, right? Which some of my base obviously is into high yield. So a lot of you have experience, a lot of you have found out the hard way. Listen, anybody who's got multiple decades in the market and gets a little aggressive, gets a little, big shot-ish, you get brought back to earth pretty quickly with margin. So this is not for you seasoned margin guys with 10, 20 years of experience. So when somebody in their youth who isn't that experienced, maybe trying it, having some success, and comes out and says how to retire in 10 years on high income funds and I'm using margin to the hill, run very fast, very far, and don't look back. Okay. So what are the differences? And there's a lot of little nuances and a lot of things you need to know. Okay. And there's slight differences in brokerages. No two brokerages are the same, but the SEC has some regulations that structure margins in a way that brokerage can offer things slightly different. But in general, they're very, very similar. Okay. So let's start with margin. What is a margin account? Well, if you go and you're young and you want to say you want to open a account, they typically just open a cash account. So what can't you do in a cash account? Well, you can't spend more money than you have. And another little nuance, if you did want to short, you can't short a stock. You might say, well, why not? That's a trade. I got the money for it. Well, because they look at it like they're charging you to short that stock. And some of the borrow rates on these highly traded, or you get in a GME type thing, GameStop, where it's flying and roaring, you can't even borrow it. And if you could, it might get up to 28, 30%. So they aren't things you really want to do as a young investor in the first place. But as you move into margin, and now they're making, Robinhood and a lot of the innovative brokerages, young and innovative, right? They want to grow. And Robinhood's done a good job of that. They will come out with all kinds of things, even, partial shares. A lot of these things are small breakthroughs, right? They've been needed for a long time, and the big old guys are stodgy and not getting it done. Um, so in margin, you need to go ask for, hey, I want a margin account, right? Even if you don't plan on using margin, it's there if you need it. I've never not had since investing. I don't even remember that, for 35 years I've had margin accounts, but I don't always use it. But I've had my fair share. I think anybody's lying to you that's done margin for 5 or 10 years in the beginning and didn't have a margin call. You really weren't utilizing it to figure out what your limits are, right? So otherwise, by default, you get a cash account unless you specify you want a margin. Well, there's things like standard margin. What is standard margin? What does it even mean? Because I haven't walked you through an example. So standard margin is 2 to 1. So you put up half the money. So let's walk through a scenario. It doesn't matter what the amount is, but let's say that you're a little more seasoned, but you've never really had a margin account, and you apply for a margin account and you put $100,000 in there. And you decide you want to buy, a couple of stocks, and you utilize 50 or 60,000, and now you're down to 40 or 30, and you really want to buy a stock. Okay. Oh, so I jumped ahead to my example. Let me finish because I'd rather have it on the screen, and I'm already telling you an example before I finish telling you what is. So typically it's 2 for 1. You put in 10,000, the broker puts in 10,000. Well, they monitor that position. This isn't like going to the bank and getting a car loan where you make a fixed monthly payment. Okay. It's not that kind of a loan. It has interest. They want to charge your account monthly interest, and they will do that, but they have some other rules and regulations. It would be like you can't drive the car out of the county. If we see the odometer has more miles than this, we're going to, what's the word I'm looking for? Repossess your car. So those kinds of things all go on in when you're in margin. There's some underlying rules that you can't violate. Okay. But if you're conservative and using a small percent and you have a bigger account, then you're going to not end up getting margin calls. But if you're out there and you're aggressive and you're trying to do the best you can, sometimes the market, right, a black swan event happens. You're just not even being aggressive, but you didn't know how to check what percentage. But let's say you're 70% utilized of the margin that you could utilize. And a black swan happens and the market drops 20% in a day and 5% in 2 more days. So now all of a sudden you get a margin call. You never experienced that. So the broker will require margin maintenance. How do you even know where you are or what that is? Everything centers around margin maintenance. Okay. So you get this 2 to 1 relationship. They'll let you think of it this way. You got 30,000 cash in your bank and you have a margin account early on, not necessarily a portfolio where you own all kinds of stocks, right? And you have a larger account, you'll get portfolio margin. And that's a different category. Right now we're talking about a simpler account. So this broker on this margin maintenance is saying, hey, it's a 2 to 1. You got 30,000 to spend. We say you got 60,000 to spend with the caveats. Okay. So margin maintenance typically is 25%. But Bruce, you say you got 30 and 70 up to not allowing margin on some high risk volatility. That is the under the old assumption. In the days where people bought General Motors and Ford and GE and IBM and simple Procter and Gamble. Well, now that we have the NASDAQ 100, now that we went through a dot-com era, that we've gone through an AI era, in an AI era, then things change. So the broker will require margin maintenance, and the amounts may go up based on the security. In the non-portfolio margin account, it's a 1 to 1. You borrow money to buy that stock. Did you do it on Procter and Gamble? That's a pretty steady company. They're probably going to keep it at 25 cents. Or did you do it on Misty and Yieldmax, right? That pays out a lot of dividend and it's very volatile. A stock like that in a normal trending market when the market's doing good might only be 30%, might be 35%. When the market starts to get volatile, it can jump to 50% or 70%, or they say we're not allowing margin on that particular security. Okay. So nothing is static here, guys, although it can be for great periods of time. Just look at the VIX. The VIX will tell you, which is what we label the fear trade. Right now, the VIX is, I forget the number, but very low. It's near historical low levels. So there's no fear in the market, which usually is a setup for fear coming back, right? When I see it this low, I say, oh man, do I want to own more? I already own a lot of the VIX, right? You can't buy the VIX, you buy ETFs and products that mimic the VIX. Okay. And so I own UVIX. It's supposed to be 2 to 1. Sometimes it's like 1.5, sometimes it's 2. I just keep buying more the lower it goes because I know we're going into September and October and it's very likely to go. But that's a whole different story. Okay. So the market moves on pullbacks can cause a broker to instantly raise Their margin maintenance. Notice I put MM. I didn't want to type out the whole name. Percentage is higher. So just doing that puts you in a precarious situation. You say, wait a minute, that's not fair. You told me that it's 25% or 30% when I started, and now you raise it to 50, and you said that it may go to 70. So I'm screwed. Well, welcome to the market of stocks. I don't even call it a stock market all the time. I call it a market of stocks. Which stocks are you in? That can tell you a lot about volatility. All right. So generally, the industry has a minimum account balance to ask for a margin account. Most still honor the 2,000. However, a broker can have higher limits, like 4,000 or 5,000 is their minimum. Okay. Now, so this we've covered general beginning standard margin account with 2 to 1, and how underlying securities, depending on, are they a NASDAQ, are they high volatility, are they an NVIDIA, or are they, Procter and Gamble? They have different risk tolerances, right? So different margin requirements of how much you can borrow in that, buying that type of security. So now let's go to day trading. Just trying to give you all the things, guys, whether this is you or not. I want to point them out because would say in the comment. So day trading margin is a different classification of margin and requires you to have, okay, an account balance of 25,000 maintained at all times. I bumped into this a million times, guys. The margin multiple can easily be 4 to 1 or much higher depending on other factors. So think about that for a second. So say I put an account and I put 40,000 in, and I'm been going to school, I'm taking classes, I'm working with a mentor, and I want to be a day trader. I want to be a full-time day trader. So I want to trade, 20 trades in a day maybe. I may trade the same stock 10 times. So it's a buy and sell within that same trading session. Okay. That's considered one completed day trade. I bought it and I sold it. I guess you could also say I shorted it and I bought it back to complete the trade. So how do you get defined as a day trader, and when do you get this 25,000, minimum requirement? What if I got 5,000 and I start day trading? Well, what'll happen to you is doing the day trade action, okay, where you bought something and sold it in the same day, regardless of the stock, okay, and do it 4 times in any 5-day business time frame, right? It could be a Thursday, Friday, then a Monday, Tuesday, Wednesday, assuming no holiday. Boom. They will send you a notice. They'll post it in your account and say, we flagged you as a day trader. What doesn't have the implication is that if you got a $10,000 account, you're not going to be able to continue doing that. Okay. So you need to have a minimum of 25. There's still, if you've got a $40,000 account and you do it, they're still going to say we flagged you as a day trading account. Doesn't, at that point, it doesn't mean anything. It just means you can't go pull a bunch of cash out and drop below 25,000 and be able to continue day trading. If your account at any point in time you become a lousy day trader, which is more than likely when you're first starting, and you're right at the 25-30 and you fall below it, then they're going to freeze your account. They're going to say no new trades, limiting you to only selling, right? You say, well, yeah, but I want to get my money and I want to close the account. You can do that. You can sell things, okay? You just can't day trade anymore. Okay. So that's something to be known and warned about. Okay, now into portfolio. Why is portfolio different? This is for the mature. It can be somebody young if they've, have come from a wealthy family. They did a bunch of crypto for a couple of years. They built up, over 100,000. They got 200, 300, 400,000, and now they're trying to do stocks. They may still do some crypto. Doesn't matter. It's the size of the account. So what it typically requires is that you own other assets. So say I got a bunch of Procter and Gamble, and Microsoft is a tech stock, volatile, but it's also a big cap stock. So if you've got a bunch of money and New York Stock Exchange type companies that are generally more conservative, don't have, 60, 70, and 80 IV, implied volatility on them, then you will have a portfolio margin, okay, account. And you can ask for it if they don't just automatically give it to you. Okay. So then what happens is you can exceed 4 to 1, depending on the classification of the stocks you own. If you own a bunch of NVIDIA, just the underlying stock and Palantir and these, you will still be able to have portfolio margin based on the worth of those, but the worth might not be the same. They may not give you 50, 60, 70, 80%. Um, accountability for owning that asset. The percentage can drop. But overall, you're going to get a greater margin than that young person starting that account with 2 to 1. Okay. So let's think about an example that you want to trade. So I haven't told you what causes it, but I wanted to put something in here. I call it a special note for those of you in high yield weekly or monthly dividends who get a margin call. Okay, this is just something I haven't experienced, but I've had a lot of people ask me that, you know, are in my Discord, that are in my YouTube, you know, hey, they're holding my dividends. What's going on with that? Well, you get a margin call. I'm going to take you through that in just a second, what causes that and what you have to do. But just understand, you got a payment coming. Let's say it's coming on next Tuesday, and you're trying to live off your account. And every time they make that deposit, you withdraw to go pay your car, your rent, whatever it is on living. If you get a margin call, it's very likely they see that cash coming in and you're all ready to take it out and you say it's gone. Well, where did it go? It went to solve your margin call. If you didn't have that, then you may have had to sell some position to generate the cash to satisfy the margin call. Okay. So I'm going to walk you through maintenance margin, what a margin call is, what has to happen, and so forth, how you got there, okay? Which is the dangerous part of overextending yourself or having the markets have a black swan and pull back, right? Remember a saying that I have? Up markets take the staircase up, right? But down markets take the elevator. So it can happen very quickly, very fast in a short period of time. Okay. And when that happens, often it's a massive liquidity hit. And what does the broker do when this is taking place? They raise the maintenance margin. Remember, they said, hey, we're giving you 50% of margin, or we'll allow you 25% of what the price is versus what you bought it at. We're putting up 50 and you're putting up 50. Okay. And we'll allow you to go down to 25% of the investment. But beyond that, you have a margin call. And that means you have to give them money or you have to sell something else in the account to generate cash. Or they will take the action for you without asking you which stock, whatever. Okay. So let's go through that example right here. You bought 1,000 shares of XYZ, not literally, right? That stock name. It just means like you bought the shares of ABC, right? It's not a real stock. Okay. So don't read anything into that. You bought 1,000 shares of ABC stock at $60 stock. So the investment 60 grand. So they look at it in one of these 2 to 1. Okay, let's go through that example first. So you're earlier, you got a 2 to 1, you don't really have portfolio margin. Okay. Doesn't matter except that you may have a greater percentage of money available to you, but you still can get the same effect in a margin call. So you supplied 30% of the balance and they supplied 30 grand. That's how they look at it. They gave you a $30,000 loan. Okay. And I'll talk about rates and what are rates. And typically they're paid once a month, they charge you. And your daily amount can vary, okay, of how much they consider they're lending you based on how much margin you have on any given day. So you don't just have a fixed cost, okay, like a car loan. So the broker contributed the other 30,000 on a 50% or 2-to-1 margin account. Might be higher if it's portfolio margin. How things can change when the purchase price of ABC stock goes down. Let's say the stock drops over a period of time down from 60 to $40. So the stock is now only worth 40,000. So here's how the broker looks at it. They're in business to make money, not lose money. They're never going to lose money. Okay. So think they might repossess the car, but the way they repossess the car is they sell the stock if you don't take action. Okay. So the broker looks at it like they have the position of $30,000 margin contribution, but now the stock's only worth 40. So they say, it's your account that's taking the 20,000 drop in price, not us. We didn't invest in it. We just loaned you money. So your contribution has gone from 30,000 to 10,000. Notice the 10,000 of the 40,000 value, you now effectively only have 25% of the value of that stock. And that was their definition of the minimum required amount. The minute that stock drops a penny, you will get a margin call. What's a margin call? Well, they send you usually a text, a screen pops up on your laptop, your phone, your desktop, whatever platform you're using to access. They may text you to your phone. Sometimes you'll get a call. I don't think they call much. I haven't had a margin call now in 12, 15 years. So, and I handle them right away. I mean, I see usually the pop up happens, so I'm not getting a phone call, and then I take some action to remove it. So only because I'm experienced, right? I know how to do that. I know what I want to do. I don't want it to progress any further. So basically, with that next penny that it dropped, and that'll be intraday, right? If it opens up 5 cents lower, you'll get something flash across your screen saying you have a margin call on it, ABC stock. So if you've reached the threshold for a margin call, if the stock drops, you will get the dreaded margin call. So you'll be, sorry, I'm reading what I've already said. All right. So here's another way that it can happen. So what happens when the market starts to sell off? Remember what I was saying? So let's say you own a bunch of these high yield income stocks, or you just even own the underlying. That can change. Nvidia, Tesla, right? But let's say you own Tesla and you own NVDW, Round Hills. And let's say that the market takes a 25% hit in one day. Could be a 10%. Wherever you are with how close you are, you can always look in your account and see what your margin maintenance is and where you stand at any given point. So you know how much room you have. So seasoned pros, people that have done this, never allow themselves to what a small black swan or 5, 10, maybe 15, 20% market move doesn't impact them because they don't want to have to go through this. Now, if they've got a lot of dry powder and they got a lot of cash in their account, then they're protected from those kinds of situations, right? But usually people use margin because they want to up how much they can have in the market. And sometimes they do that at exact wrong time. All right. So on any margin call, you must do one of two things. You must either add new funds immediately to get your position equal to the minimum required market maintenance percentage. And if that got upped on you to 50% and you thought you had, 30%, so be it. It's now 50. So if you have a portfolio margin account, you can go sell other assets in your account, or you can simply wire or what is it, ACH, which is what I use a lot, ACH money from your bank to your account, and that hits instantly in a day. So the idea is that you want to get money in there to solve it. They'll give you 2 to 4 business days. I've heard of 5, but I wouldn't mess around with that because guess what? You know how they solve it? They just go out and sell that position. And it's the very worst thing that can happen for you. What if it's a V shape? What if in 3, 4, 5 days you get the margin call on the fourth down drop day and you don't respond in a day or two, and they go out and say, I got no choice, and they sell 10, 20, 30, 40, 50, 80% of your position to satisfy it. It all depends on what the money comes to. And then you go, oh shit, I was gonna, borrow it from my uncle. I was gonna do this, and I didn't, right? So they took care of it. Now it does a V-shaped recovery and you're kicking yourself. So you were forced to sell at the low or the bottom. Happens all the time. Okay, I see a typo here. So, in reality, it can cost you dearly, right? Just the nature of the beast. So you really don't want to get that close. Okay. But when you're young and you're naive and you're borrowing a HELOC or you're borrowing money from your house and you watch some YouTuber, you watch somebody say this is my fire methodology and then they add margin to it and you're on this, I'm 29, I'm 32 and I want to retire by 40. There's ways to retire by 40, but it's not always just using margin and risk like crazy. Sooner or later you get burned. All right. So you do pay interest on your margin account, typically calculated and taken out. Well, it's almost always calculated and taken out monthly. Okay. And another way, when you get that call, right, on these high yield funds, they will take those dividends, be it weekly or monthly, when they come in. So don't just go, hey, Round Hill's paying me next Tuesday, right? It's Thursday today. So you're already planning to spend that money. And then all of a sudden you find it's not available to you. It got gobbled up to pay off the loan. Now, some of you, there's nothing wrong with this strategy. You're seasoned, you have plenty of room. You go in there and you have a big margin balance. Well, you want to start lowering the balance. So maybe you've got dividends across 10 different funds and you allocate one or two of them just to pay down the margin. Good strategy, right? So there are some tips and techniques. I'm not going to get them into here that you can utilize margin to thrive instead of survive. I'm trying to warn people how it can hurt you. Okay. So please be careful on margin. Can be a great tool sometimes when you're experienced, you fully understand it. But I think of it like a loaded gun. It's a loaded weapon. That weapon can go off at any time with disastrous effects, right? Black swans come out of nowhere sometime. Those of us with multiple decades in the market and using margin know the pros and cons. I love it when I'm in my sector. It's running. It has a it has a big pullback. And not only do I want to buy everything I can with that pullback, I want to borrow a little to go in. So I want the probabilities on my side, right? And even when I do that, I never utilize all margin that I could. I don't need to at this point. So don't always think of that youth that, I can recover from it because it's ugly, right? It can have a fatal financial impact if you use it incorrectly and get too deep in margin. Okay, so here's my warning, guys. Not financial advice. Please be careful of YouTubers or anyone that's in your circle of friends, whether it be Instagram, Facebook, wherever you get it, that talk and promote insane returns over a short period and project a multi-year or decade path to retirement based on those same insane returns with margin. It ought to be illegal. It's really not. I mean, technically, you have to be careful in giving advice. I'm not a CFA. I'm not an authorized investment professional. Um, and sometimes I tell people, this is what I'm doing. This is what my experience teaches me. But what you do your own diligence, right? If somebody copies and mimics that, that's okay. But if you're literally advising somebody, right? There's that fine line. Certainly don't do it in a public forum. Okay. So if you get caught and you're following somebody, now that's a loaded weapon that's aimed directly at your financial heart, right? It won't kill you, but it certainly will kill your finances. So please take that as a warning, guys, because that's what this is. Just an old guy with a lot of experience. I love to teach, I love to help. If this doesn't apply to you in your season, ignore it. You would know that it doesn't apply to you. And those that are experienced would nod their head. Oh yeah, I learned that the hard way too. Anybody who tells you they've never had a losing trade, anybody who tells you, they've never made a wrong decision, run and run fast away from them because they're a liar, right? They're lying to you. It's BS. All right, guys, this is Bruce with Targeted Wealth Creation. I'm going to put this out on my Patreon. I'm also going to put it on my YouTube. So either place you're watching it, it's nothing. And then I hope to do one on how to thrive and give some of those finer points. All right, peoples, have a great time ahead. Bye for now.